Okay, welcome back, everyone. Thank you for joining me. My name is Tony Zhang. I am the Chief Strategist here at Options Play. It's been a pretty eventful week with Facebook yesterday, so today we want to talk about how to trade debit spreads and use examples like Facebook to try to profit from these extreme moves. Volatility is starting to pick up a little, so I think it's a really interesting time for us to take a look at trading debit spreads. Last week, we looked at trading credit spreads, which many of you like to use. So today, I want to talk about a slightly different strategy, debit spreads that really allow you to take advantage of big moves in an underlying stock. They're completely different strategies. I don't really like comparing them very much because they are utilized for completely different views for an individual stock. So today, we're going to be talking about how to set up a debit spread, when you should consider using it, and then most importantly, how to actually manage them, meaning what are the best practices for when to get in, when to get out, those types of rules. And then what I want to do is spend most of our time showing you some real examples of stocks that you should consider taking a look at debit spreads for, and show you how to analyze the spreads themselves so that you become self-sufficient in being able to use options play and finding these opportunities and placing these trades. It's one of my favorite strategies because it allows you to really take advantage of big moves and be able to profit from that. So today we're going to show you how to go about doing this. So we'll cover a few different things. This webinar is recorded, so both the slides where I'm going to go through today is going to be provided to you in that recording, as well as the YouTube link so that you can watch this recording. For those of you, if you're brand new to options trading, if you're brand new to debit spreads, I highly recommend you to take some time looking at all of our webinar recordings. We have a specific video that we've done on the differences between debit versus credit spreads. So if you're still new to these types of strategies, I highly recommend you to take a look at the webinar recordings because it helps you kind of put into context whether this type of strategy is something you want to do compared to credit spreads. We also have quite a few useful links available to you in that in the slides, so make sure you download those when you follow along on the webinar recording. So today we're going to cover a few different things. Number one, what I want to talk about is what are debit spreads, when should you consider using debit spreads, and more importantly, how do you trade them effectively in your account. We'll wrap this up talking a little bit about debit spread management, meaning when to get into the trade, more importantly, when to consider cutting your losses or taking profits. Very, very important piece of trading debit spreads. And lastly, we want to talk about, we want to show you some real examples so that you can actually go, after you finish this webinar, log on to our platform and actually start finding some of these opportunities for yourself. That's really the most important thing, and I want to make sure everyone walks away here today feeling confident that you can utilize our platform and start doing the same type of analysis that I'm showing you here today. So what we'll do is we'll start off just by simply defining what are debit spreads. For those of you that are brand new, debit spreads, there are two types of debit spreads that you can trade. One is bullish, one is bearish. It's pretty straightforward. The bullish trade is a bull call spread. The bearish trade is a bear put spread. And we'll talk a little bit about how to construct these. I'll give you some real examples to show you what it actually means to construct these. But keep in mind that our platform does the construction for you. So you don't have to memorize how to create them. Our strategy constructor and our platform automatically does that for you. So this is really more so for illustrative purposes and for educational purposes, rather than you having to memorize this so that you can actually trade these strategies. So what I want to do is, before I kind of get into talking about what a debit spread is and everything, I want to ask everyone a quick question here. I'm going to launch a poll here. I want to get a feel for what people feel in the markets. Do you feel like volatility in markets will start to pick up? Do you think it'll kind of stay where it is, or do you think maybe it'll actually decrease over time? I want to get a feel for what people are feeling right now. I know Facebook stock was certainly a bit of a shock. No one actually felt that the markets were, we certainly feel that valuations are a little frothy and a little lofty. However, I don't think anyone foresee foresaw that, Facebook stock's going to be down 20-25%. Especially after that Netflix shock, we kind of saw a bit of a preview of that, but it kind of came right back up the next day. We're not seeing that with Facebook. Is this the beginning of a larger trend? I want to get a feel for kind of what people think. Very interesting. 2/3 of you said that you believe that volatility will start to pick up. 1/3 of you said it will remain the same, and a very few of you says that you think the volatility will decrease. And I think that's the general consensus, is that at the very least it'll stay the same, but more likely it'll probably start to pick up. And that's really where debit spreads take full advantage of volatility going higher. When stocks make big moves and they make bigger moves than expected, debit spreads allow you to profit from that. So that's really why this topic is very timely given where we are in the markets. So I think it's a great time to consider bringing this up for those of you that are interested in or feel that volatility is going to pick up, is using these types of strategies, debit spreads, that have really fully allow you to capture this increase in volatility. So let's go ahead and move on here. I'll talk a little bit about what are debit spreads. But before I do, I think the most important thing to understand about all spreads, whether you're trading debit spreads or credit spreads, is that they have defined risk and reward. This is the most important piece of spread trading that I think makes it the most valuable strategy for whether you're a beginner or experienced, because with all options trading, there's always risk. And the more you can define that risk, the better, because it allows you to really plan the trade ahead of time. If you know what your risk and what your rewards are, you're not shocked after you get into the trade. Unlike buying a call or a put, you don't really have a defined reward. You think it's going to go higher, or you think it's going to go higher, but you don't really know by how much and how it's going to affect your option price. You may not necessarily have a definitive target in mind either. When you're trading spreads, you have that defined risk and reward, so that when you're in the trade, nothing is really a surprise to you. And that really helps take the emotion out of trading, because you've already planned for it. You already know what's going to happen in the future, or what could happen in the future. So nothing comes as a surprise, which makes the management of debit spreads and credit spreads, in my opinion, a little easier. But debit spreads are even easier to manage from a risk perspective. And we'll get into a little of that in a bit later. But I just want to talk a little bit about why, debit spreads make my life a lot easier when it comes to trading. So I'm going to use a fictitious stock, XYZ, trading at $100. And I'm only using a fake stock right now because it's easier to talk in the context of how to create a debit spread. So we talked about there's two different debit spreads. There's a bull call vertical and a bear put vertical. So a bull call vertical is a strategy that is defined by buying in a near the money call. So stock XYZ trading at $100. I'm going to buy the $100 call. And let's say that call cost me $4 to buy. What I'm going to do at the same time is I'm going to sell a higher call, sell a 110 call, a call that's out of the money. And what that's going to do is that's going to bring in a credit. So let's say that brings me $1. So what that does is the combined value of the two legs, buying that $100 call for $4 and selling that 110 call for $1, my net debit is a $3 debit. And just like credit spreads, your max risk is defined based on the width of that spread. So the width is the $100 call to the 110 call, so that's a $10 wide call. And your max risk on a debit spread is defined by how much you pay. So if you're paying $3 debit for that spread, your max risk is $3. Your max reward is the rest of that width. So here in this particular case, if you bought this 100 by 110 call spread, you pay $3 for that spread. So your max risk, the most amount of money you can lose is what you paid, the $3. The most amount of money you can win is $7, the rest of that $10 spread. Okay. Conversely, if you're bearish on XYZ stock, what you can do is you can buy a $100 put, very similar to an outright put buyer, but what you're doing is when you're buying that put for $4, you're also going to sell a put against that. You're going to sell a $90 put, a lower put for a smaller amount of credit. So let's say you bring in also $1, that brings your net debit for the two legs to $3. And just like the the call spread, your max risk is defined by how much you pay for that spread. So if you pay $3, your risk is $3, and the rest of the distance between the strikes is your max reward. So again, same thing. If you have a $3 risk on a $10 wide spread, your max reward is going to be the rest of that $7. So that's how you construct a debit spread from a very academic perspective. We'll go through some real examples to show you how they play out, but it's very easy to calculate max reward, max risk of a debit spread because it's just the difference between the distance of the two strikes. Now, the goal of all debit spreads is to simply profit from a large directional move, meaning when should you utilize these trades? It's when you have stock XYZ and you think stock XYZ is going to go from $100 to, let's say, $110, then you would buy a bull call vertical. If you think stock XYZ is going to go from $100 down to $90, then you want to trade a bear put vertical. So very simple. Buy call vertical if you think it's going to go higher. Buy put vertical if you think it's going to go lower. And this is really a trade that you want to make when you feel that there's going to be a large directional move coming. Now, how do you actually construct that debit spread? So I just talked a little bit about the construction of it. Now, how do you actually put those in practical terms? Number one, this strategy is, so last week, if you listened to our webinar on credit spreads, we learned that, credit spreads are a strategy that you typically want to use on indices and ETFs. Debit spreads are kind of the exact opposite. You want to use them more so on the individual stocks versus the ETFs and indices. And the reason for this is because credit spreads, you don't want the stock to move a lot. On debit spreads, you do want the stock to move a lot. So that's why it's kind of flipped between ETFs and indices, which generally don't move as much. From a volatility perspective, individual stocks tend to have more volatility. Think Facebook, think Netflix. These are stocks that have 10, 20% moves in a day. Your SPY or QQQ or IWM ETFs, they don't move that much every day. So that's why those instruments are better for credit spreads and individual stocks are better for debit spreads. When it comes to debit spreads, you want to trade expirations that are generally at least 5 to 8 weeks from expiration, if not further. And the reason for this is because longer dated options minimize theta. So that time decay that's working against you when you buy an option, you want to minimize that time decay. And the only way to do that is by going further out. And keep in mind that just because you go further out does not necessarily mean that you have a longer time horizon on your trade, because you can always close out a debit spread a week later. You can buy an 8-week option today or even a 2-month option and sell it a week later. So you don't have to hold on to it for 2 months if you buy a 2-month option. But by buying that 2-month option, that 2-month option is going to decay relatively slower compared to buying a 1-month option. And the slower that decay, the less money you're going to lose to time decay. So that's why when you're trading debit spreads, the exact opposite strategy of credit spreads. Credit spreads, you want to trade those 2-3 week expirations because that time decay is as fast as possible. On debit spreads, you want to do the exact opposite. You want to go further out in time. And when it comes to selecting strike prices for debit spreads, the rule of thumb here is that you generally want to use slightly in the money strikes for your long option. And then we'll talk a little bit about what you should do in terms of the short option. But generally speaking, the short option you want to do relatively further out. And we'll talk about that in 1 second. So on a debit spread, when you're trading near the money options, so money, calls or puts that are near the current price, these types of debit spreads typically have a higher probability of profit and a slightly lower risk to reward for these types of strategies. Versus you can also buy a debit spread with a far out of the money spread, call option. So you don't have to just buy an at the money or near the money. You can buy an out of the money debit spread as well. And these strategies will have lower probability of profit, but higher risk to rewards. So what I really wanted to do is actually look at the details between these two different strategies and see and show you the relationship between the two to help you better understand which one's actually suitable for your trading. So when it comes to all options trading, not just debit spreads. And this, any of you that watched the webinar last week or the debit versus credit webinar will probably have learned this, is that all trading is really a trade-off between probability and risk to reward. Anything with a high probability will always have a poor risk to reward. Anything with a great risk to reward will always have a low probability. That's just life. So when you're trading a near the money calls a debit spread, that typically looks like is you're going to have about a third of your trades be winners, about 2/3 of your trades will be losers. However, what that gives you is a risk reward of, let's say, you're risking $200 to try to make $500. So a lot of people will look at these numbers and say, why do I want to trade something that has more losers than winners? And the answer is because you get paid more on the times when you're right than what you're actually risking. Unlike when you're trading a credit spread, you have the exact opposite. You might make money 2 out of 3 times, but the money that you lose on that one time that you lose money will end up being more money than you've gained sometimes on those 2 winning trades. So one is not better than the other. They're just completely different trades. And that's why I don't love comparing them, because they're not meant to be compared. They're not meant to be utilized in the same way. They're meant to be used in different times. And we'll talk a little bit about what the differences are. Versus you can also buy a debit spread that has a lower probability of profit. So even worse probability of profit, where you only see 15% winners, where 85% of your trades are losers. However, what these types of trades usually give you really good risk reward. So you might risk $100 to try to make $900. This is kind of starting to get, think of like lottery tickets, right? Where you pay very little amount of money, you're risking just a few dollars, but if you win, you collect hundreds of times that, of thousands, millions of times that. So it's the same concept, where the lower the probability that you have, the better the risk reward that you're going to get. And the question is really how well balanced these two things are. You don't want to just focus on probability, because chances are what that's going to do is that's going to decrease your risk reward, or vice versa. If you only focus on risk reward, you're going to have very poor probability. So what we really want to do is balance these two. And the question is, how do you actually go about balancing it? So what we looked at is all different types of strategies, and what we found is the optimal debit spread really looks something like this, where the buy leg, you're buying about a 50 to 60 delta call, so a call that's just slightly in the money. And then what you want to do is you want to sell a far out of the money call, about a 10 to 15 delta call against that. That is what we consider a fairly optimal debit spread that really allows you to take advantage of that full directional exposure with relatively smaller downside if the stock doesn't really move anywhere. And the rule of thumb here is that the premium on the short leg, well, you should roughly offset about 10 to 20% of the premium of the long leg. And that's really the goal of debit spreads here, is to provide you with, the main component of a debit spread is really this buy the 50 to 60 delta call. That's really what gives you that directional exposure. The sell leg is really just helping you do a few things. It's helping you lower the risk, because if you're able to decrease the premium of the long leg by 10 to 20%, that's going to decrease your overall risk by 10 to 20%. You want to reduce your risk as much as possible with all forms of trading. So debit spreads allow you to reduce that risk versus just buying an outright call. It gives you a better break-even price because you've now paid less for that premium. And what it does, because you have 2 legs, you have one long leg where the theta is working against you, but you also have a short leg where theta is working against you. You have lower theta, so smaller time decay. So these 3 things is the reason why debit spreads provide you with a substantial advantage than just outright buying a call. But what we want to provide you with is a very similar exposure to the stock that the long call provides you with some additional benefits. And that's really how we construct the optimal debit spread. Now, I know I'm throwing a lot of numbers out at you guys. There's a lot of things that we're going over, and these are all very, very important things. However, I don't necessarily expect you to memorize all of this. Again, that's why we have these slides. That's why we record these, so that you can watch them afterwards. But more importantly, Options Play is already building these optimal debit spreads for you. That's really what our platform does. You don't have to memorize this. You can simply type in a stock, click on I'm bullish or click on I'm bearish, and we already have these optimal debit spreads for you. So that's what we're going to really show you here. But this is really for educational purposes. For those of you that want to learn how debit spreads work, I wanted to break this down for you so you have a better understanding. So what we generally find is that your optimal debit spread will typically have roughly a third of your trades have roughly a 33% probability of profit versus 67% probability of loss. And then the risk reward ratio of roughly about 2 to 1. So risking about $100 to try to make $200, $250, that is kind of the sweet spot between probability and risk reward that we see that give you the best returns using debit spreads in the long run. So when should you actually utilize this? Now that we understand how they're constructed, what the benefits of debit spreads are, when should you use them? And this is really key here, right? And this is why I don't really like to compare debit spreads versus credit spreads, because they're used in completely different scenarios. One is used when you don't expect the stock to move very much. That's when you sell the credit spread. When you trade the debit spread, you trade it only when you expect a large bullish or bearish move. So this could be earnings coming up. This could be, a stock bouncing off of support or resistance. This could be a technical breakout. However you go about using your analysis, this is only a strategy that you should use when you expect a large move. So this could be breakouts or breakdowns. So stocks like Facebook is a little late. It's already down 20%. But we have a few different examples that I'll show you here in a second of stocks that are currently breaking out or breaking down. Those are the types of stocks that you want to utilize a debit spread for. A lot of times where, for example, a lot of people ask us, how do we derive the ideas that we have for our daily plays? This is really where we utilize the two indicators that you have available to you on the options play platform, our relative strength indicator, the technical score, and our trend indicators. When those two things line up, those are the things that we look for in order to find trades that have the largest potential of moving significantly higher or significantly lower. And lastly, we do not want to use debit spreads when we're only expecting a modest move. So if you think the stock's going to move 2-3%, that's not the type of scenario that you want to use a debit spread for. It's only for when you expect a large bullish or bearish move. And the great thing about trading is that there's no such thing as strikes and balls, meaning we don't call strikes and balls in trading. You can wait for the perfect pitch in order to utilize a debit spread, meaning you only utilize them when you expect a large move. Otherwise, you can trade your credit spreads. So again, I'm not trying to say one's better than the other. It's just a matter of what type of signals you're used to looking for. If you're used to looking for these types of breakouts and breakdowns, and you try to find these large moves or on earnings, use debit spreads. If you're used to just trying to find stocks that maybe aren't moving very much and you prefer those types of trades, that's when you should use credit spreads. So again, just to reiterate, if you're bullish on a stock, you think it's going to make a big move, buy a call debit spread. If you think the stock is bearish and you think it's going to make a big move lower, buy a put debit spread. Very simple. And we'll show you how to compare these in 1 second. So lastly, what I want to do is talk about, the difference between credit spreads versus debit spreads. And any of you that caught our webinar last week, you've seen this graph before. Again, debit spreads, again, are for when you have a setup and you expect, for example, this stock has been trading within a triangle for a long period of time, reaching this apex, and it finally breaks out. These are the types of setups that debit spread traders look for. They're expecting a large move to happen after these types of setups. Versus credit spreads, these are small, modest moves. So you think the stock's going to stay in a range, you think it's going to hit that top and come back down, hit that bottom, go back up, hit the top, go back down. These are small moves. These aren't what you would expect a big move to happen. But when you do have these types of moves, that's when you want to trade credit spreads. And if it breaks above that resistance level, maybe this is a bit of a false break, but maybe this could have been a potential opportunity to buy a debit spread. Didn't work out, but that certainly would be a potential opportunity because it broke out above that resistance level. And then conversely, if this thing ends up breaking below this 101, the support level, that would be also another potential opportunity to use debit spreads. But anything in between, that's when you want to trade credit spreads. And when you expect a large breakout, that's when you trade debit spreads. So make sure you understand the difference between the two, and so that you're utilizing the right strategy at the right time. And that's really the most important thing that I want you guys to walk away from today. So now that we talked about how to construct a debit spread, when you should use it, how do you actually trade them effectively? And just like any other form of trading, whether you're trading credit spreads, debit spreads, buying calls and puts, or whatever it is, risk management is really key. And that's really why I like trading debit spreads, because the risk management aspect of it is so straightforward. There's not a lot of math involved. It's just very, very straightforward and easy to remember. And the easier it is for me, the better, that the more likely that I'm not going to have my emotions come into play. As a trader and as a strategist, I've been working with clients for the last 14 years, and I've been lucky enough to work with some pretty amazing traders and see all different types of strategies. And the one thing that I've noticed over the years is that traders that are successful are the ones that keep it simple, because that's really how you try to keep the emotion out of the trade. No matter how good of a trader you are, emotions tend to get in the way sometimes. And when you have a simple strategy, it's easier for you to keep the emotion out of that, because you just have a very simple strategy, a very simple set of rules that you follow. And the simpler those rules are, the easier it is to follow. And that's what I like about debit spreads, because the rules are really simple. Not to mention that when you're trading debit spreads, or this is true for debit or credit spreads, is that you have clear defined risk and reward. This is what I was talking about at the beginning of the webinar. When you have very clear defined risk and reward, you know exactly what the worst and best case scenario is. So nothing really is a surprise. So whenever you kind of hit your targets, you take profits. Whenever it starts to go against you, you cut your losses. Nothing is a surprise. And that's the best part about trading spreads, is because whenever things come to you as a surprise, that's when we get our emotions involved. If things aren't a surprise, it's easier for us to just stick to our rules. So let's talk a little bit about what those rules are for trading debit spreads. Number one, when you enter your trade, very simple. You want to time them when you expect a large move. This is exactly what we talked about before. Unless you expect a large move, you should not be trading a debit spread. Now, once you're in that trade, how do you actually manage it? This is really where debit spreads are a little different from credit spreads, because when you're trading credit spreads, you want to hold on to that trade all the way to expiration. Debit spreads is the exact opposite. You want to exit the trade before expiration. You almost never ever want to hold the debit spread all the way through expiration. Excuse me. And on an exit strategy, there's really two things. You can either take profit or you can cut your losses. Number one, you want to cut your losses if the move simply doesn't materialize. So we talked about entering a debit spread only when we expect a large move. So if you enter a debit spread and the move doesn't happen, that's an indication that you should get out. Doesn't matter whether the trade's up or down. If your original view that the stock's going to make a big move doesn't happen, that's your reason to get out. Now let's say the stock does make a big move, either in your direction or against you. When should you consider taking profits? When should you cut your losses? This is where it's really simple. You want to cut your losses if you've lost more than 50% of what you paid on that trade. So if you paid $2 for a spread and it's now trading at $1 or lower, that's when you should start cutting your losses, get out of the trade. The trade's clearly not going in your direction. Conversely, if it's going in your favor, you want to take profits when it's reached about 75 to 100% gain. So if you bought an option for $2 and it's now trading at $3.50 or $4, that's when you should consider taking some profits, at least partial profits. So if you're trading multiple contracts, you want to at least take maybe half that position off when it hits that 75 to 100% target. If you're only trading 1 or 2 contracts, you should probably take all your profits. But if you're trading 4, 5, or 10 contracts or more, you can always take partial profits at 75 or 100 and then leave a partial of your position on so that you can try to make that 150, 200% return, which is very possible on these debit spread trades. So those are the rule of thumbs that what you should do when you're using these types of debit spreads for your trading. And this is really where it's easy, because it doesn't matter whether you buy a debit spread for 5 cents or 10 cents or $1 or $5 or $10. The rules are all the same. This is not the same for credit spreads. The credit spreads depends on how much credit you're receiving. That determines when you should take profits, when you should cut your losses, and there's a bit of a sliding scale. So it's a little difficult to teach. It's more something that you have to kind of really trade and experience and go through that process, and it's a bit of a learning curve. Versus debit spreads, it's really straightforward. Cut your losses at 50% loss, take profits at 75 to 100% gain. So make sure you remember that before you place your trade. So now let's actually start taking a look at some real life examples using options play so that you can utilize our platform to find strategies to start trading and maybe start taking advantage of these some big moves that may be starting to happen in the markets. So here I have an example of Alcoa. I'm all of these examples that I'm giving you today. This is all for illustrative purposes. This is not by any means a solicitation or recommendation to trade these strategies. I'm using these for illustrative purposes because I see certain things happening in these stocks that are the things that I would be looking for if I was a debit spread trader. So Alcoa, first of all, is a weak stock, technical score of 2, telling me this is underperforming stock. 1 month and 6 months trends are bearish. This is a material stock, which is one of the weakest sectors right now. So everything lines up, on the bearish side for Alcoa. Not to mention that, 43.5 was a bit of a support here back in June, late June, and then finally broke below that. And it finally came back to test this 43 support level that it broke as resistance. So I really think that this is a potential opportunity to get short this name. It's a weak name, bearish trends, and from a technical perspective, I think it's a pretty good setup for a short around this 43 level. So let's take a look at some trades. Now, the great thing about options play, for those of you that are brand new, is that instead of using an option chain as your starting point, so if you were looking at an option chain, this is where you typically start. So if we plugged in AA, you'd have to put it in. You'd have to then decide, okay, AA, I'm bearish on it. So what should I use in terms of let's go back. Not sure why this is not working here. So you would have to use that chain. You have to decide, should I buy a put? Should I buy a put spread? Should I trade some other strategy? Then you have to pick an expiration date. Then you have to pick a strike price. There's a lot of things that you have to first decide before you're able to see any analytics. And that's what we wanted to avoid, is we wanted to show you analytics first, allow you to play around with it, and then decide what you wanted to do. So what we have here is when you click on I'm bullish or I'm bearish at the bottom of your screen, we will always present to you 3 strategies that make sense for your views on that underlying stock without having to pick any strategies or any strike prices or expirations. And we have the 3 most popular strategies that you would take as a trader. If you're bearish on Alcoa, you can either short the stock if you're not trading any options. You can buy a put option, which is a simple option strategy to take, or you can buy this put vertical. This is the debit spread that we're talking about here. So we have the 3 side by side so that you can actually compare them side by side and see which one's best suited for you. So let's focus on this. So I talked about you don't have to remember how to set up a debit spread or anything like that because we already do that for you. We give you starting points that make sense. So here, Alcoa is trading at 42.82. You can short 100 shares of the stock, which I don't necessarily recommend you to do because that has unlimited risk. You can buy a put strategy, which does give you that similar downside exposure with limited risk. So here that costs you $215 to buy a put instead of shorting the stock will cost you quite a bit of margin requirement. Or you can buy a put vertical that only costs you $180. So we talked about your risk is limited to what you've paid. So here you're risking $215. Here you're risking only $180 per 100 shares. So you're risking substantially less money. And this $215 is only about 5% of the underlying cost to buy 100 shares. So you're basically you can take the downside exposure for just 5% of the underlying shares, or the $180, which is roughly about 4%, a little under 4%. So you can actually bet that Alcoa is going to go lower by only putting up 4% of the underlying shares. And that's really where this gives you, your bang for your buck. And then when we talk about explosive option strategies, these are the types of opportunities that puts and put verticals provide you that you simply don't get when you're shorting a stock. So Alcoa is trading at 42 right now. I'm looking at the charts. I see support around 39.55. I see support around 37. So let's say we think it's going to trade somewhere in between this. As you can see, Alcoa drops quite a bit. So I don't think it's crazy for us to say that I think it's going to hit 38 or 38.5 in the next couple of months. So this is looking out to September 7th. So we talk about going out about 5 to 8 weeks out. So this is about 7 weeks out, September 7th. Let's take a look at how the strategy will actually perform. So let's say we think the stock's going to go down to, let's say, $39, which is only about $3 out below the current price. You can see here, if you had shorted the stock, you make an 8% return. If you bought this put, you make an 86% return, substantially higher, 10 times the amount of capital that you would return versus shorting the stock. Or if you bought this put vertical, 122% return. That's really where this savings that you're saving yourself about 20% here on the cost of this trade, a little more than 20% actually, that goes to substantially higher returns if you're right on your trade. Conversely, what happens if I'm wrong? What happens if Alcoa's go back to $48? What happens? Here, if I had shorted the stock, I lose $521. If I bought this put, I'm still limited to only $215. On the put vertical, I'm only limited to $180. So not only do I make a higher return if I'm right by trading this debit spread, I actually lose less money if I'm wrong. That's why this strategy on the right gives you the higher options play score. We're looking at all potential opportunities or all potential scenarios and saying, what happens if you're wrong? What happens if you're wrong? What happens if you're right? What does that risk to reward look like? How good are they? And we compare the strategies side by side. And that's why we're telling you this strategy on the right gives you the best risk to reward. Because if you're correct, you're going to get a pretty nice return. If you're wrong, you're actually going to risk less money. That's why you're going to get that higher options play score. A lot of people ask us, how do we calculate that options play score? Conversely, what happens if this thing drops down to 38 bucks just in a few days? What happens if Alcoa drops that much in a week, right? That's also possible. So today is the 26th. So what happens if a week later, let's say next Friday, the stock drops down to 38 bucks? This tool allows you to create all of those scenarios and see actually what happens. So if we actually expect the stock to drop significantly over the next week, as you can see, instead of this strategy being the best, the put is actually the best. And that's really the power of this tool, is that it allows you to create all different types of scenarios, understand how they impact your option strategy, so that once you're in the trade, nothing is a surprise. That's the goal here with options play, is so that you have your potential risks, you have your potential rewards modeled before you get into the trade, so that once you're in it, you have already an expectation of what's going to happen, so nothing comes to you as a surprise, which allows you to better stick to your plan. So if you get this move, and you see this large move go down lower, and you see this potential profit, you're going to say, okay, that's enough profit for me. I'm getting this 140% return. That's more than enough for me. Let me take my profits. If you didn't know this, sometimes you're in this trade and the stock goes lower and you don't really know, is this good? Is this bad? Am I making enough reward? Am I not making enough reward? If you don't have that plan ahead of time, it's really difficult for you to make a game day decision as to whether you should take profits or stay in that trade. So that's why we encourage you to use the P&L simulator, understand what your potential risks, what your potential rewards are, be prepared for it, so that when you're in that trade, you know exactly when to take profits and when to cut your losses. Let's take a look at another example here. SunTrust Banks. This is one of the trade ideas that we provided today, actually. So I just want to utilize this as an example to show you why we picked this stock, right? So one of the reasons is we wanted to look at the financial sector. We always do top-down approach here at Options Play. We want to look at what are the strong sectors and then try to find strong stocks for those strong sectors when we're looking for opportunities. Then we look for technical setups to say, is there anything about the stock that gives us an extra edge? And so what we wanted to do, number one, we're looking at financial stocks because financials are one of the sectors that have been strongest going into this earnings season. It's, the big banks have been reporting fairly good earnings. And we see that a lot of the smaller banks are seeing similar type results. So we wanted to look for a bank that was that had reported good earnings, had good follow through, and from a technical perspective, looked good. So as you can see, this stock struggled to get above that 70 level for quite some time. For quite a few months, it was just very sideways. And then just a few days ago on earnings, it actually managed to pop above that $70 resistance level on fairly high volume. And what we did is we got this follow through and a bit of a pullback. And these are the types of pullbacks that gives us potential opportunities to get long into these types of trades. So that's what we identified. We identified a stock that was breaking out in a relatively strong sector that we think is going to perform well this earnings season. And, from a technical perspective, came back to near a support level around the 71 support level that we think is a good entry for a buy. And that's why we picked this stock. And what we did is we looked at the strategies. So once we pick the stock, then we look at, are there viable strategies? We use Options Play to find them. So I'm showing you the exact process that I went through last night to find SunTrust Bank. So I can either buy 100 shares of that stock, it'll cost me $7,300, or I can buy this call option that gives me very similar upside exposure. That costs me $370. So again, roughly 5% of the cost it would take me to buy 100 shares of the stock, I can get similar upside exposure, and I limit my downside risk, meaning no matter what happens to SunTrust Bank, I can only lose $370 per contract, even if the stock goes to zero. And then what we look at is the call spread. Well, instead of just outright buying that $70 call, what if we sold the 77.5 call against that? That's that 15 delta call. We've automatically found that call, sold it, and gave you a price of $325. So I'm lowering the price of my call option from $370 down to $325. So again, about a 10% savings, just in that sweet spot, 10 to 20% savings of just the outright buying that call that we get from the debit spread. And let's see how that translates into returns if we're correct. So SunTrust Bank is at all-time highs. It's difficult to say, where it can go. So we basically said, well, we think that maybe the stock can move to $75, $76 based on historical volatility. The stock moved from 68 to 68 to 72, 73, so about a $5 move very relatively quickly. So I don't think it's crazy for it to move another $4 or $5. So what happens if it moves up $4 to $76? So as you can see, if I bought the stock, you only make a 3.75% return. If you bought this call option, you make a 62% return. If you bought this call spread, you make an 84% return. So this is really where it starts to get interesting. So because I'm getting that same upside exposure that I would be getting if I had bought the stock at a substantial discount, because I'm only paying about 4% of the underlying costs. I'm paying $325 as opposed to $7,300, getting similar upside exposure. And the additional benefit that if for whatever reason, SunTrust Bank, and we never know what can happen with the markets, look at Facebook, right? We never know what can happen. And that's really the key of limiting your risk. That's the key, because we never know what's going to happen. And if it blows up in our face, we want to make sure we limit our risk. And that's what options provide you with. So even if the stock blows up, as you can see, if I bought 100 shares of this stock and the stock went back down to that $68 level, which is where it was just at a few days ago, I'm losing $525 if I bought that stock. I'm only losing $370 if I bought this call option, and I'm only losing $325 if I bought this call spread. So again, minimizing my risk and still at the same time maximizing my return if I am correct. That is the key to long-term success for trading, minimizing your risks and trying to maximize your returns when you are correct. And the key here is minimizing your risk, because things can always go against you. And if the things that go against you have unlimited risk, that's when you're going to have a lot of exposure in your portfolio. And that's why we like to use options to limit our exposure. And debit spreads really allow us to take advantage of when we're right. Unlike credit spreads, no matter how right you are on direction, you're limited to that credit that you receive. It doesn't matter how right you are. So that's why I personally like to trade debit spreads, because I like to find these opportunities that give me the highest possibility of a move in one direction or another. And I utilize the debit spreads that allow me to limit my risk. So instead of risking, here I'm risking $325 to try to make $425. Those are the types of risk rewards that I want to see. I want to potentially make more money than I'm risking. But again, different types of strategies, different strokes for different folks. This is just personally what I like to trade. And I hope that this webinar is useful in helping you guys also better understand the strategy. Even if you don't really like trading the strategy, even if you don't trade it very often, it's good to understand it, because you will have a day where you're going to see, hey, I find an opportunity. I think the stock's going to make a big move, and you're going to know how to utilize this. Using our platform, it's as easy as possible, and you can utilize our platform for all directions. So let's say, for example, you look at the SunTrust Bank, for whatever reason, you'd say, I don't agree with you at all. I think this is bearish. You can click on I'm bearish, and now we'll present to you 3 bearish strategies so you can analyze. So what happens if SunTrust Bank goes back down to $68? How much money do I make on this put spread instead of buying a call spread? We really allow you to the world is your oyster. Type in a stock, click on I'm bullish or click on I'm bearish, see the different scenarios, see which one you prefer. You can trade all of them. And once you've decided on the one that you want to trade, let's say you like the September 21st trade. This was actually the trade that we looked at yesterday. When you hit the trade button, we have what's called a strategy checklist. This is really designed for those of you that are brand new. If you've never traded a debit spread before, it tells you how to enter this into your broker's platform. Very important so that you enter it correctly, but also a strategy checklist. This is designed so that you don't make the same mistakes that sometimes we made as traders ourselves. We wanted to help you guys avoid those mistakes. So making sure that you're trading the right strategy, making sure you're trading with the trend of the stock in the market, checking for the options play score, checking if there's earnings coming up. This is something that we see a lot of people tend to overlook. And lastly, spread and liquidity, understanding how liquid the spread that you're looking at is before you place that trade. These are all things that you need to be aware of before you place your trade, and it's all on a strategy checklist for you. You just simply hit the trade button and it allows you to go ahead and look at the details and the strategy checklist. So that is just a quick summary of all the things that I want to talk to you guys about here today. I'll open this up for Q&A in a second. I just want to reiterate again, if you're looking to buy debit spreads, again, this is really only for when you're expecting a large move on individual stocks. They tend to work a little better versus the ETFs versus indices. Go at least 5 to 8 weeks out in time when you're buying these debit spreads and use slightly in the money strikes. That's really kind of the best use case of these types of strategies. So I hope you guys have found this useful. So at this point, what I'll do is I'll open this up for Q&A. If you have any specific examples or questions that you want to ask, please type them into the chat window. I'll try to answer as many questions as I can. So Carl's asking, what about legging into a debit spread? You absolutely can. I don't really see a big reason for doing so. The whole point of trading a debit spread is to get the efficiency of both legs, of one leg offsetting the cost of the long leg and having time decay minimized by using them. So it is a strategy that you typically don't leg in and out of, in my opinion. Legging in is usually something you do on 4-leg strategies where you'll leg in 2 legs first and then leg in the other 2 legs. You usually don't leg into a 2-leg trade. Also, just because of transaction costs, it's not really efficient to leg into a 2-leg trade. Barry's asking, does the platform provide probabilities of closing under or over a target price? So we only provide probabilities of the so yeah, we kind of do. So great question, Barry. So on our platform, we have what's called a trading range simulator. So what we do is we actually provide the probabilities of a stock being within a range and outside of that range. So if you have a specific price that you think the stock's going to be in, so we'll recalculate those probabilities so that you can calculate the outside probabilities as well. It's not an exact thing that you're looking for, but we do have those numbers. Carl's asking, but what if it drops to 25? Carl, which stock were you referring to on that? Were you talking about the Alcoa? If it drops to 25, then the put option will make obviously the most amount of money, and the put spread will be limited in how much money it can make. But generally speaking, if you really expect the stock to drop to 25, then you should be trading the put, right? So you should not be trading this put spread if you think the stock's really going to drop to 25. As you can see, even if it goes to 33, the put's going to give you substantially almost double the return of that put spread. So this tool is also designed to allow you to change whatever assumptions that you have and see which one's best suited for you. Timothy's asking, what is the margin / maintenance requirement for a vertical call option? Very, very good question. The great thing about trading debit spreads is that there is no margin requirement or maintenance. Your cost is simply the cost to buy that spread, and that's it, because that's the most amount of money you can lose. Unlike a credit spread, you have to put up the full max risk on that trade. On a debit spread, whatever it costs you to buy that spread, that's all it is. There's no requirements above that. Does options play calculate market maker move if you take trade extended past earnings date. So we have the expected trading range for any given expiration right here. So whatever expiration you choose will give you the expected trading range. This is not based off of an at-the-money straddle. This is based off implied volatilities, but it tries to do the same estimation as what you would typically do with an at-the-money straddle. Lauren's asking, can you show an example with weed using October 19th expiration date, please? So let's look at weed. Oh, that's a Canadian stock, sorry. So we don't, this is only for the US side of things. If you're looking for the Canadian options, you can go to tmx@optionsplay.com. I don't have that up right now, so I can't bring that up right now, but you can use this CGC. So this is the Canopy Growth. So are you bullish or bearish on this specific trade? While you tell me that, I'll answer some other questions. Would you consider fibs to estimate a new upside target for the individual stock or the VIX? So you certainly can use the fib retracements. I generally find that fibs, because they're so subjective, is difficult. But I think that if you, and this is one of the things that I talked about, in my webinar a few weeks ago on technical analysis, that it really doesn't matter which indicator you use. If you like Fibonacci retracements, use Fibonacci retracements. The key here is not what you use. The question is how consistently you use them. Do you use Fibonacci's the same way every single time? If you do, then you certainly should. But if you're using Fibonacci's today and then MACD's tomorrow and moving averages the day after, and you're constantly switching your different things, that's when you're not going to gain consistency. So if you like fibs and you use them consistently every single time, absolutely use them as your target price. That's key. I can't speak to necessarily fib levels because I don't know how you're using them. So CGC bullish. So let's take a look at bullish opportunities on CGC. So as you can see, I can buy 100 shares of that stock, cost me $2,500. Buying one call option, $240, so exactly 10% of the underlying cost, or this call spread, $160. So about, what is that, 6% of the underlying price? So substantial savings of buying that spread versus that just an outright call. And as you can see, it reflects. So if the stock goes back to 30 bucks, which is where it just was 2 weeks ago, right? Here, if I bought this call, I make 140% return. If I bought this call spread, a 212% return. So that reduction in that cost between buying that 240 versus 160 reflects in this return when the stock does go in your favor. Conversely, if the stock goes against you, you can see, you can use this tool very quickly. Now, I'm using the September one. You asked for October. We can easily flip over to October real quick. It's really easy to do that. So let's take a look at October. Same thing. These strikes are really far apart, so you don't really have a lot of choices here. But you can use them, and you can see, as you can see, 295 versus 170. So it's 142% return versus 190% return. So that's really where you can use this tool to quickly find opportunities. Is the volatility number in the platform the volatility number for an individual stock or the VIX? It's for the individual stock. So as you can see, Canopy is at 63% because this is a high-flying stock. It's very volatile. That's why it's at 63%. The VIX is trading at, what, 12% right now? So it's the volatility for the stock. Spencer's asking, you said go out 5 to 8 weeks. How soon can you execute the spread? Can you do it in less than a week? Not sure what you mean by execute the spread, but you can buy and sell the spread at any time. So if you buy an 8-week option, you can sell it the next day if you wanted to. You don't have to hang on to it for 8 weeks. So for those of you that may be newer to options, when you buy an option, you can sell it the next day. You don't have to hold it to expiration. And that's really what I was saying, is that you don't want to hold these to expiration. You want to get out of it beforehand. So if you're a swing trader and you're only in a trade for a week or two, that's okay. You still want to go and buy that 5 to 8 week option because it's going to minimize your time decay. That's really why I'm telling you to go that far out. You don't want to trade a 3-week option because that option is going to decay much faster, and that's going to work against you. Chris is asking, where do they daily plays show up first, in email, Twitter, or somewhere else? So they show up everywhere because, I know everyone likes to look at different things, but they're on our platform first. So if you log into our platform, you'll see them first. They get emailed every day at 6 a.m. every morning. and they go on Twitter pretty much at the same time they go on our platform. So they do go up on our platform first, and they're emailed out to you every morning at 6 a.m. Timothy is asking, will trading a naked call or put option expose me to more level of risk than trading spreads? Absolutely. First of all, you have substantially large margin requirements to outright buy. First of all, you may not even be able to sell an outright call or put naked because your broker may not allow you to. And you're putting up unlimited amounts of risk when you're selling an outright call. You have a substantial amount of risk when you're selling an outright put, but that's a little different. You only want to sell puts when you want to own the stock. So I'd say that that's not the right comparison. But when you're trading a spread, your risk is completely limited to that defined risk or reward on the spread. And that's really why, if you're speculating, spreads are the way to go. Selling a call or put is not really speculation on direction. That's really saying that you don't think the stock's going to go anywhere. So I don't also think that that's a fair comparison, to be perfectly honest. What do you think is better, buying the 60 delta and selling the 30 delta, or going lower and selling the at the money? Lawrence, like I said, what we generally find is optimal is buying that 60 delta and selling that 10 delta against that. Carl, yeah, so I think I answered that question on AA. If it goes down to 25 bucks, if it does happen, you should just buy the put. You don't want to buy that put op. Meaning, if you really think that stock's going to go that far down, you should buy that put, not that put spread. When you exit a vertical trade, how do you get out? You simply just, so when you enter the trade, it's a buy to open. When you exit the trade, it's a sell to close. So that's a great question, and that's something that I think if you've never traded one of these spreads before, you definitely want to call your broker and have them walk you through an order to enter the trade and an order to exit that trade. I generally find that to be useful. That's really what your broker is there for, so utilize those resources. It should be a free call. They're usually happy to walk you through entering a trade and exiting a trade. Because it differs from broker to broker, I definitely should encourage you to call your broker for that. How do you find the stocks to put debit spreads in without typing symbol after symbol? So this is where that's completely up to you. Every single one of you on this call is completely different in terms of how you go about finding your ideas, right? Some of you are technical traders, some of you are trade the news, some of you trade fundamentals. Every one of you have different strategies, and the whole point of this platform is that we cater to all your strategies. So however you derive your ideas, our platform is here to help you figure out how to profit from those ideas. I'm unfortunately not here to help you figure out which ideas. We provide ideas to you, so we have our trade ideas screen. This is designed to give you bullish and bearish ideas every day. We provide our daily play, which is another idea provided to you every day. But chances are you derive your ideas from 1,000 different sources. So what we're saying is it doesn't matter where you get your ideas from. As long as your idea is that I think a stock's going to make a big move, use our tool to help you figure out how do I actually profit from that move. And that's really what options play is here for. When I checked the STI recommendation, it showed that $0 cost. So that's something that we are aware of, and we're currently actually in the fix of doing that. So we are hoping that that will be out by later this week. Please discuss terminology. On the options play platform, I haven't found credit or debit spreads. What is shown instead of if I'm bullish or short put vertical, or buy put vertical if I'm bearish? What is that? What options play considering entering the same name of trades for which is offered in webinars? Okay, that's a good point. So basically a long call vertical is the debit spread, a short put vertical is a credit spread. So it all comes down to the strategy that you're trading, right? So as you can see, these are the two trades. One is a trade cost of a negative, which is a credit, and one is a trade cost of a positive number, which is a debit. So great point. I'll make a note of that, and I'll try to put these terminologies more in line with what you're seeing on the platform itself next time. Thank you for that feedback. I really appreciate that. That's why we do these webinars, is to help educate you. So if at any point of these things terminology is confusing, please let us know. I'll try to incorporate that next time in our webinars. So what you can do is you can utilize our platform when you use the bullish strategy constructor. The short put vertical is the credit spread, the long call vertical is the debit spread, and vice versa for puts. Can you talk a little bit more about the spread between the strike prices? Is there a percentage move of the underlying stock you want to be targeting? No, you don't. So this is really why we want to use deltas, because a 5% move in Apple is different than a 5% move in Netflix. So you want to make sure that you use delta, which accounts for the fact that some stocks are more volatile than others. So that's why we don't use percentage terms. We always use delta terms, because that's always adjusting for volatility. Greg's asking, can you explain why you should close out the spread trade prior to expiration? For example, you're bullish, you have a call vertical on XYZ at 100, 110, but XYZ has dropped to 90 near expiration. Well, this is where you don't want to let that point happen, right? This is the why we want to have these rules, so that no matter what happens between those 2 points, that you either cut your losses no matter where the stock goes. If you've lost more than 50% of that trade, you want to cut your losses and you want to take profits. That's really why. And the reason you don't want to hold it to expiration is because if you hold it to expiration, time decay is going to continuously work against you. And that time decay is just going to accelerate as you get closer and closer to expiration. You don't want that to happen. You want to maximize your exposure while minimizing time decay. The only way of doing that is to exit that trade prior to expiration. Is there a way to determine volatility is high or low for debit or credit spread? Great question, and I highly recommend you to don't do that, because if you simply try to decide to trade debit versus credit based on volatility alone, you're not effectively capturing the right deltas, because debit spreads are only used for when you expect a big move. It doesn't matter whether the volatility is high or low. The difference between whether high or low volatility is going to be a very small percentage of your profit or losses, versus if you decide that you're going to trade a credit spread here on a big move because volatility is high, you're not going to be able to capture any of this big move. That's why you don't want to use volatility to determine whether you use a debit or credit. You want it based on whether you think the stock's going to make a big move or not. That's how you determine, not whether volatility is currently high or low. When a long leg is deep in the money, what do you suggest? Roll it. When a long leg is deep in the money, what do you suggest? Roll up? So you can certainly roll up if you continue to think it's going to move higher. That's one way, but that's really just exiting your current trade and deciding what is the new strikes that you want to purchase. And that's when you can use options play again. So let's say we're looking at SunTrust right now. We're buying this September 77 and a half. Let's say the stock shoots up to $80. You would simply come back to options play, type in SunTrust again. If you think it's going to continue going higher, you look at what spread we're telling you to look at that time when it's at $80. And what you want to do is you want to close out your 75 call spread, and then you want to buy whatever new call spread that you want to do. So you do the same process that you do right now in the future when the stock did move higher. Does that make sense, Jerry? What is the volatility range shown the volatility selector? This is really just, I believe, about a 50% higher, 50% lower, because that's a pretty big range that the volatility is going to move in, and that's the range that we select here. My screen does not show the score column like your screen does. What is that setting? Are you talking about this score here in the watch list, Paul? Okay, sounds like you've gotten that resolved. Okay. Let's see. One of the trade strategies was liquidity. What do you mean by that? Is there a share volume? So it just simply means how liquid the option is. So when you're trading stocks, you might not be concerned about liquidity, but when you're trading options, you want to be aware of how liquid the option is so that you know how easy it is to get in and out of that trade. And the only way to do that is looking at the spread between the buy and the sell price. So as you can see, this is trading at 314 by 321. That's a very tight spread. That's a 7-cent spread on a $3 option. So from a percentage standpoint, very, very small. That's telling me that this option is very, very liquid. Versus if you see something at $3 by $4, that's a $1 spread on a $3 option. That's about a third of the cost of your trade just being lost to that spread. So that's how you gauge liquidity. So that tells you how easy it is to potentially get in and out of that trade. Timothy's asking, I tried implementing a vertical call strategy constructed from your platform. However, the trade was rejected by my broker, complaining that my overall maintenance margin requirement was not sufficient. I thought the maximum amount risk is what you invested in the trade. That's absolutely true, Timothy. I have a feeling that perhaps you entered that trade as a credit. But if you send me an exact example of what you did and who your broker is, I'm happy to try to work that through with you. But you should not have a trade. You should not have that rejected due to maintenance requirement. Is there a way to find debit spreads with smaller capital outlays? It's just simply doing it on lower price stocks. The lower the price of the stock, the lower the price of that debit spread. So just if you're searching or if you're doing some scans, maybe limit so that your scans are, you're not looking at stock prices above $100. That might be one way to find trades with smaller debit spread trades. Raymond's asking, Raymond, thank you very much. I hope you guys found this useful. Andrew, do you want to use debit spreads over earnings to capture the potential move? Absolutely. Like I said, when we say, debit spreads are good for when you expect a large move to happen, earnings is one of the largest catalysts of big moves in the underlying stock. So I think Facebook is a good example of, and do you have other tech stocks where you're concerned about potentially, high flying stocks that might miss on earnings? I don't know. Is Twitter one of them? Is Snapchat one of them? Do you think that maybe one of these will face similar problems that Facebook is coming up with right now? If they do, earnings is absolutely the type of catalyst that you might want to utilize spreads for. And the great thing about spreads, again, is that if you're absolutely dead wrong on the earnings, you only lost what you've paid for. You are not risking any more. Unlike credit spreads, unlike buying a stock or shorting the stock, you have a lot more risk than what you can potentially make. With the debit spread, you're limiting your risk, and that is the key to long-term success for trading. Ken, how do we find the delta spread? So we do that work for you, Ken. That's again why I say the beauty of this platform. I'm teaching you guys these things for illustrative purposes to show you that, meaning if you wanted to construct your own spread from an option chain, you know how to do that. But the beauty of our platform is that it does it for you. You don't have to know what's the 50 delta call, where the 15 delta call is. It already does that for you. So when I typed in SunTrust Bank, it finds me that 77.5 strike because that is the 15 delta call on that debit. But if you really wanted to, you can always click on the right arrow, and then we have explained strategies in Greek so that you can see the Greeks of each strategy, so you can find the deltas if you'd like. But the deltas are more so, again, for reference purposes, so that if you're trying to construct your own, you know how to do it. Are Baidu and Baba options and the like, are they rigged? I'm not sure what you mean by are they rigged. Options, Jerry, if you could clarify, I'm not sure what you mean by that question. Glenn's asking, I'm on a trial subscription, but I've seen that the paid version of your service has a portfolio tracking feature. Glenn, please shoot me an email at info@optionsplay.com. It depends on your broker. So shoot me an email at info@optionsplay.com and we can see if we can turn that on for you. Andrew, how far in advance of earnings do you recommend placing a debit spread to avoid the gamma erosion? So we generally tell users that if you want to enter these trades, you want to enter them when you expect a large move to happen. So generally right before earnings is when you want to enter an earnings play using a debit spread. So we've ran well over an hour here at this point. Any other questions? I've got some really amazing questions and some really amazing feedback, and I want to thank that comment about making sure that the terminology between our slides and what we see on our platform is consistent, and I appreciate that, and I certainly will make sure of that next time on our next webinar specifically on this topic. And again, so right now we just finished July. I'm just about to publish the August webinar schedule. Please, if you guys have any thoughts or if you have any topics that you want us to cover, please send us an email or feedback at info@optionsplay.com. I'll try to put that into consideration as I build the August webinar schedule. I'll send that out to everyone by early next week so that you guys can register for the whole webinar series for all of August and be all set for that month. So please, thank you again for everyone for taking the time out this afternoon. I hope you guys found this useful. I really, appreciate you guys taking the time out every single week, coming to us, listening to these webinars. I hope you guys find this useful, and we're happy to do these webinars for you guys to teach you as much as possible about options trading. So thank you very much. I'll email the slides out with the recording in about 30 minutes or so. So look out for those, and we will be seeing you guys next Thursday. I hope you guys all have a great afternoon.